Hello, everybody, and welcome to Wall Street Hackers. My name is Nick Pallavita, and today we're going to look at, of course, the stock market and the various different investment decisions that you can make. And with that, we're going to bring in, of course, on one of our most popular programs on the Pod TV network, the hacker himself, who is a graduate of the UCLA, who received his degree in economics, also a law degree from the University of Miami, and an MBA from NYU, spending 17 years on Wall Street, who knows a lot about what goes on in the markets, none other than your favorite Peter Bennett. Peter, welcome to your show.
Oh, thank you. I love the way you always say that. Welcome to my show. Guess it's true. So welcome, everybody. This is going to be a special edition of Wall Street Hackers. Normally, of course, we have the market report. We give you the 5 most interesting stories of the week. And I think a lot of times we find stories that you will not see elsewhere. And, because I'm exposed to so much. And then, of course, the investment of the week. But we're doing something different for the first time this week. We have a special edition. So what we're going to do is we're going to focus on which stock sectors might perform best in 10 years and even longer term, and also which ones might suffer. And so we're going to first look at macro opportunities, the overall opportunities and concerns in the marketplace. And then after the break, we're going to look at micro opportunities and concerns sector by sector for many sectors. The ones I do like, the ones where I have a lot of concerns, and I'm going to spell out some of those macro and micro concerns for you. First, some disclaimers, as always, when we're talking about investments. This show is for entertainment only. There are no guarantees on any investments. Anybody who says it's guaranteed, other than a CD, and even that's not guaranteed against inflation, is pretty much not 100% explaining the risk. These are only our opinions, and you should consult your financial advisor. So Yogi Berra may have said, it's attributed to him, but it's questionable, quote, "It is difficult to make predictions, especially about the future." Well, I think that's quadruply so when it comes to the stock market. It is really hard to make predictions about it because there are so many different moving factors, and there are micro and macro concerns, as I mentioned, and opportunities. The other thing I point out in the opening is there's something called an efficient market theory, one of the big things they teach you at MBA, and a lot of people know what that is, or you can look it up. But it's basically that all information is already priced into the marketplace. So if that's the case, and if it was true, then probably all stocks on a risk-adjusted basis and all sectors on a risk-adjusted basis would get the same performance. But I don't necessarily think that's true. But the trick is to figure out basically where the market is right and wrong, looking at the long run, because it's so hard to project the future to begin with. So let's start looking at some of the macro opportunities first, the big time opportunities in terms of the world situation. And then after a short break, we will go into the micro in each sector. So first of all, this is obvious, but we live in a fast changing world. It is so rapidly changing now, the most in history in many regards. We're in the information age and things just keep moving along. So there are opportunities in that and a lot of risks in what's going on. The opportunity, as I said, is to outthink the market, because we're in the information age and people in general believe in narratives. And there are a lot of false narratives out there. I mean, I'm not going to politics. I'm not going to anything, especially on the show. We try to be neutral on that anyway. But there are a lot of things people believe because we're in the information age, because it's spread through the internet or through the media or through colleges and other educational institutions, that aren't true. But because it's widespread believed, people go along with it and they don't question it. So the opportunity really is to outthink some of the narratives. So first now we're going to the risks. And unfortunately, I don't want to be negative here, but there are a lot of risks in this world. But the point is to find the opportunities where there aren't risks and there are opportunities. And try to be positive. Okay. So first, the obvious one is high inflation and higher rates for longer. This show has been talking about higher rates and higher inflation for a year and a half to 2 years now, saying the Fed was behind the curve. And even now, the market is pricing in a short span of long-term rates, but I don't think so. There's a lot of reasons why I don't think so. We've mentioned on the show a study of 16 countries where inflation went over 6% and unemployment was below 4%. And the average return time that it took to bring the inflation rate down was slightly over 10 years. So that's not like, okay, next year everything is going to be under control and we don't have a problem. So that's the number one that everybody is starting to realize, but the market is, I think, still delusional about it. The second area is geopolitics, and there's subcategories of geopolitical risk. Well, the obvious biggest one is war. I mean, if there's a massive war in the Middle East, particularly, then that could really disrupt the economy. Although it will be good for oil prices, where we have, we'll be talking about the oil sector. But the second risk is deglobalization. And I think that's much more certain, although not positive. But I think it won't be a major factor going forward in the next decades. And the reason is because businesses will move from China, particularly, to other developing countries. So it doesn't necessarily drive the prices up if a business picks up from China to diversify and moves to Vietnam or Thailand or Mexico or South America. It does cost them some money to make the transition, and that will be inflationary. But also some of the business may come back to the United States, and that will be inflationary because of the cost of production. The third thing, though, is relatively certain in terms of geopolitics. Because of the tense situation in the world, let's say, countries are likely to keep spending more and more on their military. The United States is probably going to spend more. Europe's probably going to spend more and keep spending as they've done. I mean, if they just keep spending more and more, on ammo and everything going on, this is inflationary without a doubt. So that will tend to keep inflation going. Third risk, another big one and maybe certain. So demographics is destiny is a famous expression, and we have aging populations around the world. There's 2 points about that. Number one is governments have massive underfunded and non-funded liabilities for healthcare and Social Security or pensions, depending on the country. So I have read that the amount of unfunded liabilities in the United States alone are more money than all the stocks, bonds, and real estate combined. So everybody's concerned about in the United States, I'm just using that example because I have the numbers in front of me, but everybody's concerned about $33 trillion, which is concerning itself, $33 trillion in debt. And what will that do in the future? But many people think the Medicare and unfunded liabilities for Social Security could be 150 trillion, 100 trillion, 200 trillion already. And those will come due. So and it's not just the United States, I always point out. I've looked at European countries, Asian countries, South American countries. Every country is offering free healthcare, basically, which is even worse because in the United States, it's only Medicare hospitalization and part of Part B Medicare. But in many countries, it's supposed to be free totally. So if you haven't put any money away and you have an aging population and you have no money aside, that's a big obligation in every country. And also massively or largely unfunded pensions and retirement security systems in pretty much every country I've looked at. every country I've looked at. And interestingly, too, it runs about the same shortfall in the United States as everywhere else. So that's the first thing, because governments, this is a big risk in terms of what's going to happen. And then the other, and by the way, I might as well get into it now. So my theory is, and I'm pretty sure this, governments are going to, well, this one I'm almost positive on. Governments are going to use yield curve control, which you can look up, to lower interest rates in the next few years. They're going to start for sure. They have to. Why? If you owe trillions and trillions, hundreds of trillions of dollars, it's bad enough you have to print money because you can't get it out of the economy, or you'll take the money from everybody. So you're going to be printing money, but you don't want to pay interest rate on it. You can't pay interest rate on it. Japan has used yield curve control now for, I think it's 16 years, somewhere around there. And they've kept rates very low, above zero at times, but very low. And the United States also already did in World War II, driving rates down. It's basically the government buying bonds from itself to keep rates low. So if they fail, by the way, oh my gosh, then we've got Zimbabwe, the whole thing explodes, because now you're looking at inflation rates that are astronomical, and money won't be worth anything practically. But then real assets like oil or maybe gold would be the place to be anyway. But I don't think that's going to happen, because the economy won't take that. And governments won't want it, and they can keep buying money from themselves and doing this bond game. So we're probably going to get zero rates in the next 6 years is my prediction. And there's reasons why I picked that, but I won't go into that in this show. The other thing is, about maybe 20 years ago, I read one of the most interesting stories, and it shaped my investment philosophy. And it was in Barron's, and they took 1,000 years of stock market history. Where they get that, they got it from United States, England, and Japan. And they found almost a perfect correlation with the following. And you never get perfect correlations. But they said it was almost 1.0. And it was when populations less than 50 are growing compared to those who are aged over 50, stock market went up. And it was highly correlated. When populations over 50 were growing relative to populations under 50, the stock market went down. So this is, with that kind of correlation, a big concern. And why does it make sense? Well, other studies have shown why it makes sense, and we know why it makes sense. People who are under 50 or under retirement age are saving for retirement. So they're putting money away, they're investing. But as people are getting older, they start reversing the process. They retire, they stop working, and they start pulling money out of their accounts to live. So it's probably going to happen. I mean, I would say almost certainly. And so demographics is a big concern for the future in terms of rates. And I think it's going to go down. As a footnote again, zero rates will help in some ways, but it again depends where you're going to be, because there's so many other risks. So some other risks. The U.S. states, and probably lots of provinces and other places and whatever, but the U.S. states have very underfunded liabilities in terms of their retirement plans and healthcare promises to their employees. Many U.S. and many corporations around the world, I should say, have very underfunded pension liabilities. And that is a problem, especially because it will leverage any low performance in the stock market. So if rates do go down, then a lot of companies are going to be affected by low rates and ultimately by what I think will be stagflationary environment. And that will hurt their stock market returns. And they depend on it to earn the money to pay the pensions. So that means there's more problems with the economy, because there's shortfalls in the pensions. So still another concern. I'm not a negative person. It's just I've never seen so many political and geopolitical issues, and it's because we're in risks, as they put down there exactly. Another concern that I've had for a long time is energy underinvestment. So oil and gas companies, something we talk about every show pretty much, have been putting in less than 50% of the capital they were putting in before into oil and gas projects. Every year now, they're putting in a fraction of what they used to do. Why are they doing that? Because of so many countries creating barriers to them doing it, because they're putting 10% of their capital into environmental projects like carbon sequestration. And also because if you're in a terminal business, or might even be, you're very cautious with your capital. So these are long-term projects, but down the road, there's a very good chance of large energy shortages. And that's a perfect example of narratives, and we'll talk about that in the energy when we get into the energy sector. Finally, AI, which creates opportunities for companies and concerns for the economy. So the pluses is AI will definitely save companies money. The thing is, it will do it probably, or it will do it certainly by replacing human labor. And there are projections. I mean, McKinsey Consulting has scary projections. I think Goldman has said that. I've read it all over the place. Elon Musk made incredible comments about how AI might endanger society. And the thing is, people look at gas lights and cars replacing horses and say, no, this wasn't a problem. It just advanced society. But this is the first time that machines can actually physically and mentally replace people. And that might make us obsolete to an extent. And that's a concern only from a stock market perspective or investment perspective, because the consumers are the ones who have to spend. We have a consumer-driven economy around the world. And if people are then on forced, maybe government incomes or, income replacement, or just they're hurting because their jobs are being replaced, then that will affect demand. So sorry to be negative, but there are a lot of situations and you have to be realistic about them. And there are opportunities too. So let's take a quick break and advertisement, and then we're going to go sector by sector with some of the sectors I think are very promising for the future, and some of the sectors that I'm shying away from, and at least one that I think there's opportunities that I can't decide when to get in, but I think there will be opportunities. So we'll see you after the break.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Culiet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
So here's a quick rundown of sector by sector, what I guess, because there's no certainty, but I think we've done pretty well over the last year and a half, I would say, pretty well, to say the least, in terms of our picks. But so first we'll start with the energy sector. It's been our favorite for years. The narrative that solar and wind are replacing oil and gas is false unless there's major changes, and they're not going to be almost certainly. So if you look at projections for oil and gas use to 2040, 2050 internationally, US, it's not going away. Developing countries are using more and more, and solar is growing, but it's not going to replace this need. Sorry. And so we particularly like pipelines. And we've mentioned those. Pipelines have most years have had a historical rate of return around 17%. And there was one period where they didn't, but in general, you're looking at 17% annualized return. I believe they have safety like a utility because they're demand pull. They've got large dividends and also growth. And, you know, there are investors, they say, who are dividend investors, growth investors, and value investors. And it's pretty hard to get all three. And that's what I prefer when I can find it. It's hard to find those. Next, open air shopping centers. I especially like grocery-oriented shopping centers, much more than malls, which I stay away from, by the way. The grocery-oriented shopping centers are very defensive because they've got guaranteed traffic. A lot of these have good yields and good cash flows, especially the one I've mentioned recently. SRRTF is an incredible value right now, I believe. And then there are also, there's been very little building of new open-air shopping centers. And there's also high demand for the space and very low supply. So that speaks very well for a positive sector. Some sectors I'm avoiding or waiting on. Office REITs. Oh my gosh, I've been saying this for a year and a half, but people are realizing it now. There is a huge issue because of remote work. And these leases are going to unwind over the years. People are just going to say, okay, my lease is up, bye. So what's going to happen with those properties? Well, this is why I'm avoiding storage REITs and medical REITs, because the storage REITs particularly, it's pretty relatively inexpensive to convert to a storage REIT. I won't touch those now. Medical REITs, a lot of those medical REITs have medical offices. It's easy to change the sign to medical offices. And some will be converted to real estate, residential, and that might affect some cities residential, but that doesn't mean I wouldn't touch residential. Banks and insurance companies, two issues. One, a lot of them have big investments in commercial real estate and office real estate. So not touching those, but also the other thing is, I don't think the market is going to have the kind of returns we've had previously. Historically, the market's gotten 10%. If you look at a 100-year period, different periods, it's usually 10%. Occasionally, Nick pointed out on a different show that I think there was a period of maybe 9 years where it was flat or down. But most periods, you're looking at 10%. But the thing is, going forward, we discussed it last week's show, I think the best you're going to get is 6%. And I think inflation is going to run 3 or 4. I don't think they're going to get down to 2 at all for years to come. And I think that's the best. You may even not even get 6. So let's say you get 3 or 4. Well, these insurance companies and banks are long-term investors, and they need the returns to basically run their long-term businesses. So I don't like those at all. One area that's surprising that I stay away from is defense stocks. And I have for a long time because I read that they dramatically underfund their pensions. So they have a large underfunded liabilities. So I pulled an article up from Investors Business Daily. The best one I could find was a couple of years old, it's 3 years old, but this is the same situation probably with every single company as it has been, and I recognize a lot of these names. And so I'm going to mention some in there and also some other companies and sectors that have these large unfunded liabilities, and they're going to be a drag on performance. First of all, out of the 25 largest unfunded liabilities in the S&P 500 companies, you can see Lockheed Martin, United Technologies, Northrop Grumman, Raytheon, and Duke. And then also you have industrials, including GE, DuPont, 3M, Honeywell, and not surprisingly, totally the auto sector, General Motors and Ford. And that's a decent amount of those 25 to mention. And there's definitely trends there in certain sectors. So this is going to be a problem for them, just like state governments, just like anybody who owes money, if you can't get the kind of returns on bonds, if rates go back down, or on the stock market because of stagflation. So, then you have to sacrifice, your business performance. One that I kind of have only temporarily is consumer staples. I like consumer staples, and I was in there. I pulled out. And one reason I'm concerned is if you look at XLP or RSPS, these are large funds that hold consumer staples. They show negative cash flow of 10 to 11% over the last year over year. So that's not good because of rising interest rates. They're struggling, these businesses. That's one I have to really figure out when to jump into, but right now I don't have a lot of interest in it. But there will be a time, because that's the safest sector normally, or one of the safest sectors, and they will ultimately have the power to adjust to any interest rate environment, or most interest rate environments for sure. So finally, we get to tech, and then we're going to bring in Nick. And tech is the toughest one of all. I loved tech for years, and I liked Microsoft, I liked Google, I liked KLAC, but there's a bunch of issues there. Number one, the valuations are so high, incredibly high. Second of all, tech is the area. Hey, Nick. Second of all, this is the area where there's the most rapid change. So as two examples, 3 of the largest 5 tech companies in 2000 no longer exist at all. So 2 of those are Alcatel and Lucent. I forgot the third one. But these are companies that were doing very well and went poof. So they look great in 2000 and they were tech. So who knows what will happen in this rapid changing world. But here's even more concrete example. It just so happens it was in Barron's Weekly this week. And I was really surprised by this because I thought, I can't decide, but the cloud is dominating. That's another narrative, right? The cloud is going to dominate. Well, it turns out that there is risk in the cloud based on this article, and it was on the cover even. And it said that the cloud is not certain because PC makers are making AI-based personal computers. In other words, they're going to have AI on laptops. And it turns out that AI on laptops could be more efficient, more secure, and more affordable than the cloud. So everybody's like, oh, the cloud's growing, right? But I don't know now, because this would disrupt these cloud-based companies dramatically. All of a sudden, the PC business looks great, and they're the ones who are going to be growing astronomically, and the cloud, and people are going to be moving away from the cloud. So in 10 years, 5 years, it's hard to predict. I'm watching the market, though, because just like consumer staples, I think if there's a big shakeout, or at some point, if there isn't, but after a while, I might feel safe to go back and check. But I'm waiting to see what happens, because I think the risks to the downside are a lot more than the upside right now. I don't see a lot of upside because there's so much valuation in there. Anyway, so we discussed a lot this show so far: macro concerns, micro concerns, and where we think the opportunities and many risks are. Nick, your thoughts?
Earlier in one of our programs, we had somebody that was very positive on the United States, and he even wrote a book based on what's going to happen the next 50 years, and he believes the U.S. will still maintain its dominant position in the world. Then when I look at the demographics that you're seeing, I'm going, hey, it's not that easy, because we have a lot of issues relating to unfunded liabilities. And also, Peter, one of the big problems in our healthcare sector. Healthcare is 20% of our GDP. Let's imagine if every $100 you make, 20 goes to healthcare. And then we got another problem. Our government is 25% of our GDP. So every $100 you make, you give 25 to the U.S. government and $20 to healthcare.
Yeah, that's $45 out of 100 just for those two, and those are very productive for people.
And see, the thing is, it gives private industry very little to play with, because almost half of what you make will go to healthcare and pay the government to manage your healthcare. That's a big chunk. And how long is that going to be sustainable? And we saw that in Japan with an aging population. I liked your your thing about if you're over 50, countries go down. Well, we have an aging population, and we may end up in a Japanese stagflation, very little GDP, if any, growth, and frankly, a very difficult times ahead.
Okay, so let me jump in, and then you can make some more points. But you know, 2 points. One sort of addition to your footnote. So it's not just the United States. With the again, the world has demographics of extremely aging populations. Actually, China has, I believe, the worst population because they had the one child, and then they finally moved to 2 child, 3 child, 4 child. Now they said more, have more, have more. So they have a huge, I mean, even bigger than everybody, but everybody's just unbelievable in terms of unfunded liabilities. And same thing with retirement plans. But so this is a demographic problem. So it won't necessarily displace, you know, the United States from where they are, you know, or anything, because they're all going to have these same similar issues. If anything, I would say the opposite, that the United States is more equipped to deal with this in some manner because it's a richer country than most or all in general. So that's the first point. But the second point, I totally agree with you on stagflation. See, what's going to happen is we have so much going to healthcare, so much going to government, and inflation's and maybe energy prices are eating away at the consumer. So at some point, it's too much strain for the consumer to keep spending. We already see so many indications of the consumer being stretched now. So at some point, the system is not working for the consumer. And plus AI potentially replacing a lot of jobs, but worldwide again, these are worldwide problems. So what you get is a lot of flat in terms of, you know, a lot of the market's investment performance. And you have to be really selective in terms of what sectors and what stocks you pick. It's hard to get returns. 30 years ago, you know, throw it in an S&P 500 fund and just ride it. And that's the mentality right now, which is helping keep the market up. But that mentality doesn't necessarily apply to the future, because that was a time when interest rates were going down. There was globalization versus non-deglobal, you know, versus deglobalization. A lot of these trends have reversed now, and AI is coming and all these different things. So the past is an indicator of the future, as they always say, but it doesn't prove it. In this case, I think it definitely could not be, it could be very uncorrelated. 2 good points, Nick. Go ahead. What else?
well, you know, the other problem we have, we brought the network together because of financial education, Peter. Our financial education, our education system in general is pretty poor. The United States.
Wait, let me footnote. Not pretty poor. It's horrible.
Our K through 12 doesn't even operate in the top 25.
Exactly. You know, they don't even have, like, a lot of schools don't offer business sense, economics, although it's, you know, a slightly growing trend. It's smart to do that for schools, but you know, where do people, if they're not economics major in college, learn, you know, basic economics?
Financial education, which is the reason the network is pretty poor. And one demographic, which is very interesting, is 70% of our population has 10% of our population own 70% of all the assets. So that 10%, if you're in the top 10%, you're listening, world is good for you and good for your friends because they're also in the top 10%. Life is good. The bottom 70% can't get a hold of $1,000 in the event of emergency.
Right.
And of course, the argument is they spent $400 watching Beyonce, another $400 watching Taylor Swift, and then they had to buy some popcorn. And by the time they did that, the $1,000 was gone. So they're busy watching Old Age Survivor on TV, The Voice. They have no financial education, and they just spent their $1,000 on Beyonce and Taylor Swift.
Excellent point. And we're running out of time.
70% of our population, Peter.
Yeah, that's a perfect example, because people don't have the education. So it ties into your point originally, because maybe if these people had had an education, they'd say, wait a minute, I shouldn't spend $1,500 or $1,000 on a Taylor Swift ticket. You know, especially see her twice or whatever. And, you know, it's like, I need to have a balance in my life. You know, there was a saying that I loved years ago. They said, a rich person said this, very wealthy person. They said, you know, I pour wine into my glass and I only sip the edges until it overflows. So, you know, you have to have that balance of, saving for the future and building assets. But you're right, it's financial education. Unfortunately, we're out of time, but we try to be educational. And I think we're one of the most educational shows on the internet. So thanks for watching. As we always say, you can catch a new episode every Thursday and Saturdays, depending on your distribution channel, every week.
This show goes on every day of the week.
Oh, I know that, but the new episodes come out.
The new episodes every
That's why I always say that. Yeah, as Kim always says, get healthy, get wealthy, and we will see you next week. We will be on next week. See you soon.
All right. Bye-bye.
Bye-bye. See you, Nick.